The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome. I'm Nikki Panagopoulos, a member of the PFA Executive and a Fund Manager with Australian Unity. Before we start, I'd like to take this opportunity to acknowledge the traditional custodians of the land we are located on and pay my respects to elders past, present and emerging. I come to you from the Wurundjeri land of the Kulin Nation here in beautiful Melbourne. Some might say not so beautiful. I'd like to introduce the second of the PFA's three-part learning series, which is looking at property capital markets through a global and local lens. I'll take the opportunity to thank Real Capital Analytics, who are only speaking today, but also providing us with the logistics to run the session. We will hear from David Green-Morgan, Managing Director of Asia Pacific for Real Capital Analytics. David will be speaking to us for both sessions this morning. Unfortunately, Ben Munn-Henry is unwell and cannot join us. David will first present to us on what has been happening internationally and provide a global perspective. And whilst David is providing his update, please don't hesitate to ask questions via the Q&A. Before we begin, let's run our first poll for today and ask the question. Whilst you ponder your thoughts, let me introduce David Green-Morgan. David has over 20 years experience in the real estate industry across both the public and private sectors. He specialises in delivering market-leading real estate capital markets data, research, analytics, and strategies to clients. David's expertise lies in the movement of capital across borders and between regions. His 20 years of experience is truly global, having lived and worked within the real estate industry in London, San Francisco, Vancouver, Sydney, and now Singapore. Immediately prior to Real Capital Analytics, David was at JLL and Cushman & Wakefield in Singapore and Sydney, where he covered capital markets research around the world. He started his career in the UK with Investment Property Data Bank, IPD, where he analysed the real estate portfolios of some of UK's largest private sector pension funds, using data analytics to improve performance. Before I hand you over to David, let's see the first poll results. Too high. Okay, that's interesting. It's almost a split between too high and about right. Well, that's very interesting. So now let me hand you over to David.
Great, thank you very much, Nikki, and good morning to everybody from Singapore. Hope everybody is keeping well wherever you are around Australia. It's great to be in contact with you all again, and just a get well to Ben, who did most of the work for this presentation. I'm simply the undercard jumping in to take most of the credit, but just wanted to give you a sense to begin with of what we're seeing around the world in terms of capital markets investment into commercial property. Obviously, it's been very much a roller coaster over the last 12 to 18 months around the world, but we're certainly into a very strong recovery period at the moment. This chart just goes up to the end of Q2, but our Q3 numbers are just being finalized at the moment. And again, I think it's going to show that Q3 showed an even stronger bounce back, particularly in the US, which declined more than anywhere in 2020 as they came into the pandemic slightly later than us here in Asia Pacific, and we're seeing that really strong bounce back in terms of activity around the world, and particularly as we get onto Australia in a moment, you'll see that the bounce back in Australia has been just as impressive as what we're seeing in some of the other markets. So this is why I think we're obviously at the moment, the percentage changes look quite extraordinary and in many places are setting new records. But obviously we shouldn't forget just how big the decline was also last year. Globally, we saw declines in Q2 and Q3 of almost 50% in transactional activity. But obviously the good news was that these were well above what we saw in the GFC. And as we all know, people have become accustomed to these new working practices. Good to see that some of us are back in the office, but obviously the whole working from home and the impact on people's working lives is still very much in the early stages, and I think will affect obviously investment markets for many years to come. What I did want to show you is, I guess, at the global level, some of the macro changes that we're seeing in terms of people's investment strategies. And obviously this is being reflected in both the money that's being spent, but also increasingly the money that's being raised around the world. And two or three of these big themes. The living sector is obviously becoming a mainstream investment class globally. Now, for many years, it was confined to the US, and indeed, the apartment sector has now overtaken the office sector in the US to become the most attractive, at least in terms of volumes, the most active investment sector in the US. And also in Europe, we're starting to see it really accelerate. And I think this quarter is going to see a record for European apartments. So these are, don't forget, these are apartments built for rent, not built for sale. And we'll come on again to that in a second, and what it means for Australia. In this part of the world, really only Japan is I would say, a fully functioning investment market for apartments and multi-family. Elsewhere, it's still very much in the infancy. We see the odd deal here and there, but really nothing to write home about. Obviously, as Australia knows just as well as everywhere else, the industrial sector and logistics is really taking off at the moment, and the sums of money being paid for these major portfolios, such as the Milestone portfolio we saw earlier in the year, is quite extraordinary. And I think it's something that we're going to see for many years to come, as long as the stock of investable grade assets remains as high. And certainly on the development side, we're seeing a lot of obviously logistics and industrial development all around the world at the moment. So with those two sectors growing almost exponentially at the moment, something has to give elsewhere. And as you can see, the dark blue line right in the middle of these bars, the office sector is starting to get a little bit squeezed in the middle of apartments and industrial. And as you can see, back in 2007, offices were almost half of all investors' allocations into the commercial real estate investment market was offices, and that's been fairly stable, for many decades. And of course, many investors have huge allocations into the office sector, even if they're not increasing those allocations at the moment. So all of these changes that we're seeing on the occupier side are obviously going to have huge implications for investment managers and portfolios moving forward. And of course, the other major theme is what's going to happen with retail moving forward. And again, that's probably quite relevant in the Australian context, because we're actually seeing a bit more activity in retail in Australia than we are in many other markets around the world at the moment. The other major theme I just wanted to mention briefly at the kind of the macro level is the continued rise of China overtaking Japan as the biggest investment market in this part of the world. Japan has really struggled to recover from the pandemic. As you can see, it was for many years the biggest market in the region, and the last 2 years China has crept ahead and will based on our numbers so far, will almost certainly be the biggest market in the region come the end of the year. But interestingly, it looks as if Australia may pass Japan for the first time as well in 2021. So a combination of, you know, lots and lots of capital and activity and opportunities in Australia, not certainly being matched in Japan at the moment, and that's something that obviously we'll be focusing on over the next few months as well. Also, just to give you a sense of what we're seeing from our Q3 numbers in the US, and you can see here we're looking at volumes and pricing. The CPPI is our pricing indices that we use around the world to look at where prices are going. And as you would imagine, with such a bounce back in transactional activity, no surprise that volumes and pricing is moving in most of the sectors, apart from, as you can see, CBD offices, which are proving to be a bit of a laggard at the moment, not just in America, I should say, but also in some other parts of the world in terms of pricing. So I think we're starting to get a bifurcation within sectors as well as between the sectors in terms of what investors are really looking at around the world. And just to come back to this, the apartment sector, multifamily, no surprise given the weight of capital that we've seen, and these lines could be repeated for many of the major apartment markets around the world at the moment. We're seeing that really strong yield compression and movement of capital into the sector quite aggressively. And I think, you know, there's a multitude of reasons for this. Obviously, residential prices have risen substantially around the world, so affording a house has got more expensive for most people. There's obviously the demographic shifts that we're seeing, the attitude to home ownership and the availability of mortgages for many younger people, I think is also a factor that's driving people more towards maybe the rental sector than would have been the case even five or six years ago. So I just wanted to leave those themes with you as we go through the presentation, but I'll just let anybody jump in with any questions you may have on those initial slides.
Thanks, David. And I suppose I wouldn't mind having a question. Are we seeing a structural shift into that industrial space, or do we think that that might just be a temporary reallocation?
Well, I think it's more of a structural shift, and certainly if you look at a lot of the capital raising numbers that are out there, there's you know, definitely a bigger proportion of capital that's being raised either specifically for industrial and logistics and data centers, or part of a bigger diversified fund, which is, you know, probably allocating a bigger proportion to industrial. And I think as we saw in terms of the transaction activity, which obviously eventually reflects the capital raising environment, you can see that retail is being downweighted by many groups. Offices is either being downweighted or just holding steady, but it's the industrial and the if you want to call them the living sectors that are starting to see more capital being allocated. I think the one on the industrial sector is whether there's sufficient stock. Obviously, we've seen a lot of activity over the last few years in most countries, actually. But I think obviously that there needs to be a consistent supply of opportunities as well for investors. So I think that could be the one limiting factor in the short term. But I think, as I said, we do see an awful lot of new logistics and industrial stock being developed globally as well at the moment.
Can I just
David,
remind
if I
everyone,
could just...
sorry,
Nikki.
If anybody wants just to ask a question, they can use the chat session. You don't have to just, so please don't hesitate to use the chat session.
Thanks, Nikki. David, just one question, please. I noticed the relative underperformance of offices, not negative performance, but certainly sort of hovering around zero. Is that driven by rental incentives primarily that's making values stable, or is there any adverse cap rate movement?
There was initially some adverse cap rate movements, I would say, particularly probably in the first or second quarter of when the pandemic hit. But it's been very sporadic, I would say. Different cities have reacted in different ways. And as we know, going into the pandemic, pricing was at record highs in most of the major office markets around the world. So some leveling off or cap rate expansion maybe was not necessarily a negative. Obviously, in those first few months of the pandemic, the longer term implications were much harder to visualize and to calculate, because nobody really knew how long COVID was going to last. I mean, I don't think any of us really thought it would last this long, but here we all are still kind of living through it to different degrees in different countries around the world. And the one consistent message, I guess, is we're still really not sure of the impact on the office market. But certainly rental growth, I think, is going into 2022 is the really big question.
Yeah, great. Thanks, David.
So I've got a question from the audience. David, with industrial yields compressing globally, what might be a trigger to see yield expansion in the sector?
Well, as I mentioned, I think what normally brings property prices grinding to a halt is a dramatic increase in supply, usually. And I think that given the scale of construction that we're seeing in some locations around the world, that I suspect would be the natural sort of adjustment mechanism in the cycle. However, on the counter side, the weight of capital is still enormous into commercial real estate. Interest rates are still very low. Finding yields in fixed income is very difficult. I guess we're starting to see the bond market maybe tell us that interest rates should be rising around the world, which obviously for institutional investors may see allocations shift slightly. But if you look at many of the announcements by the really big investors, and of course we've got many more big investors in commercial real estate now than we did 10 years ago, they're moving. Even if they move from 10 to 12%, that's typically a $10 to $20 billion shift in capital coming into the sector. And I think that's the counterbalance to the increase in supply on the industrial side. And obviously the dynamics are being driven by the big macro trends of e-commerce, the change in all of our lifestyles, the ordering from home, the delivery to home. So it's also within the industrial sector, obviously, we're seeing demand become more city-based rather than, many years ago, it was all about the much bigger sheds on the edge of cities or even in relatively remote locations.
Okay, there's no other questions. So thanks for that, David. Now, before we move on to the next session, which focuses on a local perspective, let's run our second poll. So again, I'll let you ponder a bit and come up with your thoughts on that second poll. And just before David presents to us on the local market and just giving us that perspective, and let's see if there is a perspective that aligns with the global perspective, we'll have a look at the results of our second poll. Oh, interesting. Interesting. Debt. I would have thought healthcare would have been a leader, but debt is a leader. So that's probably a topic for us to consider, David. But let's, I suppose,
Yes.
before we answer some questions on debt, maybe we have a look at the Australian overview.
Sure. Yeah, that is an interesting dynamic. Of course, many investors now have debt strategies as well as equity strategies, and in some markets, actually, getting exposure through debt is easier than getting it through the equity side. But maybe we'll come to that in the Q&A session towards the end. Yeah, just to touch on Australia and go into a deeper analysis on Australia. And as you can see here, we've just actually released our Q3 report this morning. So thanks again to Ben for doing that while he was in recovery mode. And you can see here, we're at 70% year-on-year change in terms of Australian volumes. You can see just how big the increase has been. Australia slightly more affected last year than many other markets, particularly in Asia Pacific. It was, along with Singapore, one of the worst performers in 2020, but obviously that recovery has been well underway now for the last three quarters. And I think, interestingly for Australia, and we're not seeing this everywhere, is that 2021 at the moment is ahead of the 5-year average as well. So I think that just shows the strength of demand that has been pent up during these various lockdowns and various restrictions and the severity of the restrictions. And also, I think, as we'll come on to in a moment, the demand that has been from offshore capital for Australia during this period. And I think this, obviously, we expect this to continue going into the final quarter as well, based on our, based on our initial numbers and the pending deals that we've got for Australia. I think we will finish off with a very strong end to the year, as is typical in the real estate sector. A few just touching on that cross-border investment, and obviously we've seen the kind of the roles and the nationalities change over the last few years in terms of investment into Australia. This year in particular dominated partially by the Milestone deal, which was a mixture of Singaporean and Hong Kong capital coming in. You can see just how that has increased the Singaporean allocation, although it's been relatively strong for many years. I guess the notable feature is the kind of the expansion and then the contraction of the Chinese and in part the Hong Kong capital as well, although we're starting to see a few more signs of life from Hong Kong at the moment. I guess the other notable feature this year is the Korean activity, which has been, considering how much capital the Koreans have exported globally, Australia has only seen a very small amount proportionally from the Korean investors, although NPS have done one of the bigger office market deals this year in Korea, which is interesting. I think it remains to be seen whether we'll see some of the other Korean investors follow suit. NPS obviously a slightly different form of capital than some of the other Korean investors, but you'll see there also just how much capital is still flowing from Europe and North America into Australia. But certainly the Singaporean capital has been at the margins, the big increase for 2021 at the moment, and not just into the industrial sector. We're also seeing some office market, and of course we've also seen some retail investment from Singapore over the years as well. And so what does that kind of mean for our running totals compared to previous years for Australia? I guess maybe no surprise given what we said earlier, that office running ahead of last year, but still lagging a little bit compared to 2019. 2019, which actually was a record year for investment volumes in Australia. You can see there, retail really picked up this year, interestingly, and I think we can probably touch on that in a bit more detail in the Q&A session as to why we're seeing capital move back into the retail sector. Again, something we're not really seeing in many other markets. A lot of investors have really turned their back on retail in a lot of the other, particularly the European and the US markets. Asia, slightly more contradictory. And of course, you can see there just how industrial has exploded in 2021. And as we were touching on, I think to keep that momentum going, we're going to need to see a consistent supply of good quality stock coming to the market over the next few quarters. I mean, just touching on this bifurcation within sectors, and here we'll see the split between CBD and non-CBD investment volumes, and you can see the recovery is pretty stark in terms of the capital that's gone into non-CBD markets. This is the kind of the change in volumes between the different time periods, but again, as we saw from that US chart, a definite focus by investors on the suburban markets, which, you know, for many years after the GFC kind of fell out of favor, and pricing really didn't move very much in the suburban markets. You know, the focus was really on CBD, good quality, and we saw a lot of tech firms in particular move from maybe business park locations into CBD markets, which really accelerated the pricing and accelerated the investment. Whereas now, I guess, again, it's all part of this post-pandemic working lifestyle that we're all going to go through. And I think it will be different city to city, is my impression. And those cities with maybe longer commuting times will see, again, sustained activity and sustained investment. Although I did see something in the newspaper in Australia today about, I think Dexus have a portfolio of assets on the market, most of which seem to be CBD assets, also being bid very, very strongly. So I think we're in this phase where maybe we're not really quite clear as to where the market may move longer term. So we see these changes, and we're trying to make sense of exactly what these changes mean for investment strategies moving forward. And again, of course, the all-important question is on pricing. And obviously the issues within the retail sector, particularly in the shopping centre space, have been apparent for a number of years. And even before the pandemic, you can see their regional shopping centres were starting to see yields move out quite significantly, now starting to plateau a little bit. And I think that's kind of representative of people taking a view that maybe some retail assets, the pricing has become more attractive. And so we're starting to see a shift of capital back into some of those retail locations. Whether they'll be 100% retail moving forward, I guess, is the big question. But no surprise, you know, CBD, even despite the slowdown in transaction activity, the pricing really hasn't moved too much. And you can see suburban offices, after kind of a bit of a plateauing in pricing, has now seen some pretty aggressive price and yield contraction over the last 12 to 18 months. And, you know, industrial shows no signs of weakening at all at the moment, you know, with logistics obviously taking the lead, but logistics obviously becoming a bigger part of the overall industrial market, as well as, you know, some life sciences activity and data center in particular, where we're seeing an awful lot of capital with probably not enough investable stock out there at the moment. So going back to the first poll, in terms of, I think it's understandable that people who've been in the industrial markets for many, many years probably do feel that industrial pricing is reaching a very strong peak. But I think as we were discussing, that weight of capital is still trumping any possibility in yield expansion or price declines at the moment. The demand seems insatiable for the moment. And one point we did want to raise, and again, Ben has written extensively on this in the last few months or so, and this is the rise of the alternative. And I guess you could put those debt strategies into this segment as well, although getting accurate numbers on debt in Australia is slightly more problematic at the moment, a bit easier in the US. But I think what's interesting here is both the growth, but also the breadth of segments that investors and particularly institutional investors are prepared to look at the moment. So, and again, I think there was a story this week about another big healthcare deal, childcare deal that may be going through in Australia. So you can see childcare, hospitals, medical offices, pubs, which is obviously a uniquely Australian investment market, service stations, student housing, which boomed last year and has kind of come off the boil a little bit, but I think longer term will be another emerging investment possibility for the capital. And as we mentioned, the tech and data center, which again, it only really being held back at the moment by the lack of investable stock in that particular segment. And with that, Nikki, I'll pass it back to you again for some more questions.
Thank you very much, David. Well, there's quite a bit of information there, isn't there? Interesting, those cross-border movements and Singapore picking up. So, yeah, well, they do tend to sort of seesaw a bit. So we'll see if that holds. We do have a question from our audience, and one of the questions is, multifamily yields seem higher in the US than Australia. Does the higher yield environment in the US make this easier to make multifamily work in the US than in Australia, where yields for residential are lower? And I suppose we didn't have in Australia, I'd say that in your last chart there, David, maybe multifamily sat in the other category, but it is an interesting question to see if we can make that work here in Australia.
Yes, and I know there's been lots of discussions around the build to rent sector, which I guess is the most closely correlated with what we call multifamily in the US. I mean, it's interesting that yields are lower in Australia than they are in the US, because we've seen such yield compression in that multifamily space. I guess the one thing that does hold the yields up a little bit is the sheer volume of stock in the US, but I think it's a strategic as well as obviously a search for yield. I think that investors are increasingly looking at the whole living sector as somewhere that they can maybe slightly more easily deploy capital, particularly on the development side, because as we know, there isn't a huge amount of build to rent investment opportunities in Australia at the moment. They are going to have to be created over the next 5 to 10 years. As I mentioned, Japan has a far more functioning multifamily sector, and that's where a lot of the capital tends to end up in this part of the world, looking for that type of exposure, because it can obviously be slightly more risky going into the development side of the equation. But I think certainly Australia, bears all the kind of hallmarks of a place that could have a very successful and quite large, build to rent sector. Certainly, we're seeing it in the UK taking off quite successfully, and a lot of institutional capital moving into that space over the last 5 to 10 years. Europe has always had a relatively big rental sector. Of home ownership is much lower on the European continent than it is in Australia, but it's always been rather sleepy, for want of a better word. The yields have always been very, very stable, and it hasn't tended to be very investable, actually, because the ownership has been very, very long term, you know, many decades. We're now starting to see that open up a bit more. And as I mentioned, I think this quarter rather, we'll see Germany it'll be a record year for apartment investment in Germany. There's been a very large $30 billion, I think, worth of merger between two of the biggest apartment REITs in Germany. So I think that's indicative of the way that the sector is expanding at the moment, and that will obviously have an effect on yield. So if the audience thinks the residential yields are low now, just maybe wait until lots and lots more of this capital starts to be pumped into the sector.
David, before we sort of take the next question from the audience, I'm just interested maybe to have a little bit of discussion about cap rate movements. I mean, traditionally in valuation, as you see values rise or fall, it's driven by rent growth and or cap rate compression. And obviously we've seen a lot of cap rate compression, almost to sort of levels, or probably definitely to levels that we've never seen in this country before. If you step back a number of years, and you and I are both old enough to have worked through cycles, cap rates in Australia are always traditionally maybe 1 or 2% higher than other major global markets, particularly in Asia. And that was possibly driven by the fact that our interest rates were higher and our bond yields were higher, which was kind of a reflection of sovereign risk. Not saying that Australia was risky, but as a far off land from many parts of the world, sort of asset pricing was slightly different. So we've sort of seen now a shift in cap rates, kind of almost alongside where we see in other mega markets around the world. Is this a structural shift, do you think, that's sustainable? Because obviously there's an awful lot of pain when cap rates go the other way. A yield moving from 4 to 5% can be a 20% write down in value. And I'm not suggesting ever that's going to happen in the short term, but just I'm interested in your views about this sort of major shift that's seen these phenomenal yields being delivered here.
Well, I think you're right, Paul, and even going back to kind of 2013, there was still a differential between Australia and many of the other developed markets around the world. You know, we initially saw after the GFC cap rates decline quite significantly in the US and particularly Western Europe as investors started to come back into the market. And I think what we saw around 2013, 2014 is that particularly global investors realized that despite the complications that maybe sometimes go into the calculation of Australian yields with incentives, obviously playing their part, which can confuse some investors. I think the gap between what we were seeing in Sydney and Melbourne and New York, San Francisco, London, Paris, Tokyo, Singapore, and Hong Kong was so wide that the capital was almost compelled to come to Australia. And we were obviously even at that time in an ultra low interest rate environment, which I think most of us thought wouldn't last forever, but the way we're going, it may well last much longer than any of us thought, even though there is obviously now a bit of a battle between inflation, interest rates, bond markets, equity markets, and obviously, real estate rental growth, particularly in the office sector, I would say. So I think the next 12 to 18 months is looking a little more maybe uncertain in terms of the wider global capital markets. But I think now Australia has made the move, Paul, to be on a par with other global investment markets. It's now always the 5th or 6th biggest investment market in terms of volumes around the world. The movement of capital is easier than ever between, wherever you may be in the world. And of course, we've seen the rise of Korean investment. We've seen the rise of Norwegian investment, groups that 10 years ago would never even have been on the horizon. The Chinese have come and now they've kind of gone back, not really selling, but obviously not investing as much overseas because of the restrictions and the environment. But you know, longer term will still be a very important source of capital, I think, for commercial. So I don't think Australia is suddenly going to go back to where it was 10 years ago, where there's a 100 basis point gap between what we see, particularly, you know, for the Sydney and Melbourne, the kind of the gateway markets into Australia. I think they're now on a par with you know, the other major investment cities around the world. And I think whatever happens in global capital markets, you know, will affect every city. It won't be isolated, I think, just to Australia, unless there is, for some reason, a huge blowout in inflation in one particular country or another for, you know, very local domestic reasons. But I think that, you know, the argument and the discussion on inflation is something that we could probably spend the rest of the day talking about, because I don't think anybody's quite got the answer or the reasons behind it at the moment.
That's tremendous, David. And I think probably just another thing just to add to that is that we are seeing globally as a very transparent market and also a liquid market. So there's a lot of security in that regard.
Yeah,
absolutely. I mean, it's just as easy to get out of Australia as it is to get into Australia, which of course is, for the global investors, is always a consideration. I think sorry, just to expand, Nikki, I think the interesting thing is that we still don't really see Australian investors in other parts of the world that much. And, you know, given the capital base in Australia, and I think maybe this is playing a part on why the recovery has been so strong in Australia, is obviously not only is it being driven by offshore groups, but also domestic capital now is, you know, incredibly active and looking for opportunities. But, you know, equivalent sized economies and equivalent sized, you know, particularly pension funds and pension bases around the world are much more active globally. And you know, we do know that Australian capital is obviously going into funds and going into REITs, public markets and things like that. But certainly on the direct ownership side, we still really don't see Australian capital doing very much around the world. So I think that's obviously the big change from pre-GFC, when Australian capital was incredibly active for you know, for good or bad, in terms of the returns that eventually were delivered.
Yeah, well, that's a good point there, David. No, thanks very much for that. It is your question, Paul, and your response there, David, is a good segue into the next question from our audience, which is, how do you think about the potential impact of two cost of debt factors impacting office separately? First, the prospect of increasing interest rates and interest rate rises. Second, shorter lease terms from tenants unsure about the working from home impact to space needs.
Yeah, well, you put all that together, and it's quite a complicated outlook, isn't it, for all of us moving forward. I mean, obviously, we know that a rise in interest rates is going to have an impact on the cost of debt at some point in the future. So that's coming back to the point we were making earlier in terms of how is that going to impact on the cost of lending, and eventually that will obviously have an impact on yields. Although, you know, given the weight of equity, I don't think necessarily it's going to be a one-for-one, you know, a necessary adjustment. I think, and we've seen in other cycles where, you know, property yields have remained below the cost of debt. I think we saw that even for a period in Australia in kind of 06 and 07, where interest rates were very high, but property yields remained relatively, you know, relatively low. So I think it's probably more an indication. I think probably a bigger factor will be this whole post-pandemic working environment that we end up adopting. And again, I think we're at such an early stage of this, and you can see just from the cameras here, Paul and I are in the office, you're at home, Nikki, and if this was a Friday, probably Paul and I would be at home as well. And I think how we all evolve and how this, and I guess what's happening is that we're all being given as individuals a lot more power to decide how we want to work or where we want to work. And of course, when you give individuals that level of power, we're all going to make different decisions. And when you're deciding how much office space you need, trying to take into account everybody's individual preferences is incredibly difficult. So do you go hot desking? Do you go collaborative space? Do you limit how much time people can have in offices? Do you say you can only spend this much time? Do you, is it a booking system where we all have to get up at 5 in the morning to book a space for that day? Or, you're staying up till midnight to find a space for the next day. So I think it will naturally evolve, and different companies will have different attitudes, and different sectors may have different attitudes. And how that's going to play out, I think that as we've seen over the last few years, even pre-pandemic, there was a demand for shorter leases because companies were finding that change was happening quicker, was happening more often in their own sectors, in their own companies, and signing up for 10 years or even longer was proving to be very difficult. And so I think there was already that demand from tenants for shorter leases. And again, how that plays into lease structures and how that plays into incentives, because obviously the shorter the lease, the harder it is to give a bigger incentive, because how are you going to recoup that money back? And on your, the first panel session you did a couple of weeks ago, I think was interesting, talking about the role of incentives in Australia and how that may evolve. I think that's going to be the big issue, and for next year, definitely. And I think it may only become apparent when we see some very big lease expiries coming up and what decisions those companies make in terms of what type of space they want. And I think we're seeing kind of mixed messages from different office markets around the world in terms of how this is all going to play out. And I guess what I'm saying in short is I don't have any answers to how it's all going to play out at the moment.
No, I think that's so flawed at the moment. You're so right. But I mean, let's take an example of all of us sitting in different rooms, and I'm sure that if we were in the same room having this, discussion, it'd be a much better environment, and a lot more collaborative even for our audience. So I think longer term, my thoughts are that culture can't be delivered perfectly in collaboration, needs to be delivered with people being in the same space for most of the time. And I think as social beings, we need a bit of a separation as well from from our working environment and our life. I think what will happen, in my view, is we'll probably find that we'll being given that opportunity to make these decisions now, I think we'll find that people start to gravitate back to the office just for the things that I sort of said before. But I think in the first instance, as you say, David, very difficult to determine where it's going to land, because I think maybe organisations are taking an easy option as well, thinking it's better not to have large leases with space requirements. It probably looks good on their books. Anyway, let's segue to the next question, which is again, another sort of space requirement question with office, and hopefully some of my thoughts may have resolved some of this. But similarly, are we likely to see yield expansion in the office sector as a result of possible reduction in the need of space if employees don't return to the office, or is it likely to be offset by the reduction of new construction and supply?
Well, I think what we are already seeing is that poorer quality offices are struggling, and I think that's where some of this is coming through in our pricing mechanisms, pricing indices at the moment. Is that there's definitely, as you would expect, if there is going to be an overall reduction in office space demand, then that's going to open up opportunities in better quality buildings for tenants who were maybe in B or C grade offices previously. And I think we're seeing investors are obviously taking that view that longer term, these B and C grade offices, not just for working from home, but also for environmental reasons, which is becoming, if it wasn't already, mainstream in investors' decision-making processes, and is probably going to become even more important after this, latest summit that's going on in the UK next week. I think it is when, regulations around environmental standards are obviously going to be tightened, and the timescales are probably going to be reduced for people to make these adjustments. And as we know, commercial buildings around the world are a big contributor to greenhouse gases. You can't get away from the fact, not just in the construction, but obviously the operation of those buildings moving forward. And I think luckily for Australia, you've been at the forefront of adopting and implementing and enhancing environmental standards within office buildings in particular for many years, and that should give Australia maybe a slight advantage moving forward in the attraction of capital, because obviously there are certain factors that are completely outside of our control, such as the climatic factors, but certainly on emissions, on how buildings are built, will be increasingly important. And we've already seen many investors, again, tends to be driven by pension funds who are obviously being put under pressure by their members to invest only in high quality, high grade, environmentally friendly buildings and environmentally friendly companies. So I think, again, just like the work from home debate, the environmental debate, and maybe even the type of companies you want to attract to your buildings will play a part in how capital is allocated over the longer term. And that will all play into rental growth. That will all play into how companies look at your buildings in terms of their suitability for what they want to do. So I think we're entering a period of increased complexity, both for landlords and for tenants, in terms of. But as I said, I think Australia stands at the moment in a very good position, because many of these standards are already ingrained in the decision-making process in Australia, and new buildings that are built are obviously already to a very high quality environmentally, which is not the case in many other countries around the world.
I think if I can just jump in there, Nikki, please. Completely agree, David, with everything you've said there. I think also the next 2 years will be really interesting as we see the supply of new space coming onto the market and how that actually leases up, because that will dictate the real performance of the asset. Sublease space, it always kind of sits there. You've got a tenant who's trying to get rid of a couple of floors. It's a slightly artificial market, but I think the real sort of performance measurement will come as new buildings that are being built do lease up. And traditionally they do. And as David has made comment about the environmental issues, well recognition, etc., neighbours, all of that will impact on the take up. Provided there's not a gross oversupply, I think the market should remain relatively competitive and perform satisfactorily.
Yeah, no, I totally agree there. And I might just add too, Paul, I think with that sustainability, I mean, that's David, you sort of raised a very good point, and a whole, I suppose, webinar discussion. But I think there's also, you overlay, and as landlords may be becoming a bit difficult because you overlay the carbon, neutral strategy or current carbon zero strategy that's coming out, and we try and focus too on being carbon neutral, and where is the offset between new developments, or what's the measure, new developments or refurbishing older style buildings to make them a lot more sustainable, and do you have carbon, do you achieve better carbon measures through refurbishment than new builds? So that's another question for sustainability and that we could explore. But we do have another question, and it's directed at me. Nikki, Australian Unity is quite active in the healthcare space. Do you see that the levels of other institutional investment sharply ramping up into, sorry, I'm struggling to see investment sharply ramping up in the short to medium term? I think absolutely that's probably, on the money here. I think that definitely we will see that other institutional investments, and we've already started to see that, haven't we, going into that healthcare space. But I think it goes to what you've also highlighted in that other assets, David, with, the other alternative assets that are, probably have a little bit of a social infrastructure thematic to them, with childcare in particular, but definitely institutional players will come into, aim to. I think the challenge we have here in Australia is it is a finite. It's a bit like like the industrial logistics sort of sector. Healthcare, it can be a bit of a finite sort of pool. You don't have a lot of private hospitals, coming out of the ground on a daily basis. It's a small market, and even, I think where you might need to see some change, and where the institutional players could come and probably embrace that a bit further is, a lot more PPP projects, with government, particularly some of the work that we've sort of, Australian Unity is doing out in Brisbane in the Hurston Quarter project. So, engaging with government to deliver on private and public sort of, healthcare amenity. I think that's the last question. Leave it with me. Thank you very much, everyone, and thank you very much, David Green-Morgan. I think that was a very good session, and quite a bit of information, from the global and a local perspective. And now I'll hand over to Paul.
Okay, well, thank you, Nikki, for moderating today, and to our speaker, David Green-Morgan, and behind the scenes, Ben Martin Henry. Thank you to Real Capital Analytics for your very valuable contribution today. Thank you so much. We appreciate it very much. Our third and final learning series event will be on the 23rd of November. Subject is capital raising in a pandemic. And we have Mark Pratt from Australian Unity, Stephen Bennett from Charter Hall, and Ben Harrop from Centuria, speaking on that market, which is fascinating, been one of the biggest capital raising years in many times. So we look forward to that. And thank you to our delegates for attending. We hope you've enjoyed this, and we look forward to seeing you at the next event, and also a very active calendar for 2022. So thank you to everybody.
Thank you
all.
Thank you, Nikki.
Thank you, David. Paul.